Hi, this is Tron Welch with Welch Financial Planning, and I want to go over the concept of sequence of returns and how it impacts the risk of your retirement income. So planners such as myself, we often use an average return on a year-to-year basis to make sure that you have enough assets to retire at. And really what this discussion is showing the weakness of that assumption of average return. We know that in practicality, the stock market goes up and down year in and year out. It doesn't run linear of that average. The sequence of returns actually shows not only is it the average return during the time period of your retirement, but when those returns occur. I'm going to show you a really simple example of when that has negative returns in the early part of your retirement, and then another example that is favorable returns early in retirement, and you see two vastly different outcomes to that retirement, and that's what makes the financial planning so difficult. So let's go to our chart. So starting here, let's make the assumption that you retired in the year 2000. You want to generate income for 20 years. So as we remember, the year 2000 was a negative year, 2001 was negative, and 2002 was negative. It was the first 3 consecutive down years in the stock market. You'll see under this illustration, starting out at withdrawing $50,000 a year, and then we did add inflation on there, that under this scenario, you will run out of money 15 years into your retirement in the year 2015. So certainly not the outcome that you were looking for. The average return during this 20-year period was 7.6%. Now, let's flip those sequence of returns or those returns upside down and show you the impact of that. So this chart is showing the exact returns of the prior chart, just turn them upside down, meaning the return from 2019 in the first chart is now the return for the first year of your retirement, which was positive. So the average return of these two illustrations is the same. So in 2000, you started out with a 31% gain, a fantastic number. And now you see at the end of 20 years in 2019, not only did you make it for that income for that 20-year period, but your portfolio still has 1.475 million in it at the end of the 20 years. Certainly drastically different than the first scenario. And the only thing that changed there was the sequence of returns. It's a really interesting concept, and it creates a lot of volatility in your portfolio. Looking at the same data, but just kind of shifting it around a little bit. Under the favorable sequence of returns, you could actually withdraw starting at $92,000 a year, which is significantly more than $50,000. You could take $92,000 a year, which is a 9.2% distribution rate, and still have money little left over at the end of 20 years. Conversely, at the unfavorable sequence of returns, a distribution rate of $42,000 or 4.2 will get you to having enough money through those 20 years. The only thing that changed was the order that you experienced those returns. So a lot of times, the highlight of this is really showing the power of having to be conservative on your distribution rate, because you have to be able to weather a long period of down market. Now, some of this is a little bit exaggerated because you should have some assets not in the stock market that will temper this, but this is appropriate on just this illustration. So there's a couple other things to keep in mind, and a little bit of what do you do if you start running out of money later in retirement? Well, there's a couple things to keep in mind. One of them is spend less, and that is a little bit of a natural occurrence of what's going to happen during retirement. As you age, you just tend to spend less. And that's the joke that I say in every financial planning class that I've ever taught is, do you have an 85-year-old in your life? And when you say yes, I ask if you ever see him in a new shirt. And it always gets a chuckle in the room, and that is the piece that 85-year-olds just aren't really buying. They're just not interested in new items, no new shirts or furniture, and their spending just goes down. One of them is that there always is longevity, and it's not the outcome that you're really looking for, but passing away earlier than you hoped for will certainly avoid and minimize the risk of running out of money. But then there's some other things that we kind of call parachutes in the retirement, that we run the financial plan. But then what do we do if we're going to run out of money? And some of the parachutes start with downsizing of the house. There can be a chunk of change that can then get you into the final station. So inheritance, we're seeing that more and more often, and just a modest inheritance coming in can make a dramatic impact to your retirement. And then we use the bucket system in our office, which then segregates money between low risk, medium risk, and high risk, or low, medium, and high volatility, so that down years you are protected. The money that you need in the next couple of years is protected from a big down market. And so these are the things that we use in order to protect our clients from sequence risk, which is unpredictable as you launch into retirement. So I hope this is helpful to you. If you have any questions on it, feel free to give me a call. Be happy to help. Have a great day, and we'll talk to you soon.